Rajeev Agrawal is now joining us. He's managing partner and fund manager at DoorDarshi India Fund. Rajeev, great to have you with us here on the program. Thank you very much for your time. Prashant, this side. Are we looking at a broadly kind of risk-on phase once again for equity markets, especially the best performing markets, which is India and the US? What's your sense?
Absolutely. I think you have seen in the last few weeks, especially as Fed and the various Fed governors have come in and talked about, they are comfortable lowering the rate. The equity market has taken off. And I think as that happens, the world market is also pricing something similar. And therefore, the risk-on trade that you're talking about, Prashant, is something that is playing out in full force right now.
And it takes us to basically looking at newer highs in that sense, both in the US and India, Rajeev, you would imagine?
I think this market, as last time you talked about, Prashant, that this is a Teflon coated market, and I feel so, and everything that we are seeing sort of continues to confirm the same. And I feel like at this point there is nothing really which is a big hurdle. I think in the past interest rates were a hurdle, and now that is also being taken out. So at this point, I think, unless in the US, of course, there's a big election coming up and we will see how that plays out. So that is a big uncertainty, and we'll have to sort of wait on how that plays out. But overall, I think from an Indian market perspective, I think things are looking pretty good.
Hi, Rajeev. Good morning and good to see you. Thanks a lot for joining. And Rajeev, do you think we're getting a little ahead of ourselves, though? This Teflon coated, buy the dips. It's been working. It's become all too easy, actually. Your view, and also you don't shy away from naming a couple of stock sectors that you like. Anything you've added in the last couple of weeks?
Yeah, so I think, I think this is a market one has to be careful. Just because we are hitting new highs doesn't mean that we should let our guards down. And, when everybody is greedy, one has to be fearful, as Warren Buffett says. And so I think that is something that we are sort of doing for ourselves, which is to ensure that we are asking for more margin of safety as the markets keep running up, because it's very easy to let our guard down and just go with whatever the markets are doing. But we are continuing to look for new opportunities. We always do. And frankly, at this point, given how the markets have done, it's very hard to find that many new opportunities. What I have talked on your show in the past has been in the banking and the NBFC space, and that space continues to look interesting vis-a-vis the rest of the market.
Okay, the point is, Rajeev, that the market, at least here in India and maybe even around the world, markets seem to be tiding over every possible issue, every possible hiccup. I'm not even calling it a crisis. And there's just buying at every dip. I don't know, when was the last time in your career you saw this? Are there any parallels? And how should one navigate a market that basically refuses to fall? And you're saying it's tough to find buy ideas. What should investors be doing?
Yeah, so I think one of the things is that if we don't find good ideas, we're happy to keep cash. And so that is one thing I would encourage investors to do, is to, if they're not finding good ideas, don't be in too much of a rush to chase whatever is working, because when things go down, it's very hard for you to then figure out what to do. And so I think the important thing is really to keep checking your thesis, ensure that you are comfortable with the companies that you own, look at the new data points, and revalidate your thesis. And especially as the prices keep running up, you have to decide from there on what has been the returns. So I will give you an example. Today, I was reading Wall Street Journal, and they were talking about the S&P 500 forward price to earnings is around 25 times. And when S&P 500 is at 25 times price to earnings, the forward return for the next decade is almost zero, is near zero. So really, people think markets are doing well, and therefore it will continue to do well. They extrapolate. But the problem is, as the markets go up, the forward return keeps coming down. And so one has to be very mindful of the fact that the forward return will not be as good if the prices keep going up, and one has to account for that. Now, the momentum may carry on for some time, but at some point that momentum will break if the fundamentals don't support that momentum.
Rajeev, I'm just cross-checking that data point. It was a very interesting one that you brought up. If I heard you correctly, the data says that the last time the S&P 500 was trading at forward earnings of 25 times, it was a zero return decade, the next 10 years that followed. Is that right?
That's right. That's right.
I'm going to remember that.
Happened around the 2000, in the 2000 period where the S&P
Okay.
500 was that high.
Okay.
All right, Rajeev, we leave it there. Thank you very much for joining us, and appreciate you being here on
Yeah.
CNBC TV 18.